Hello and welcome to this week's episode of Companies and Markets Weekly from Stockopedia. I'm Lawrence. I'm joined in this week's episode by Graham Neary and Megan Boxall. We've got a bit of a bumper episode this week. There's been a lot happening in the UK and US stock markets this week. One piece of feedback that we've implemented from listeners, is that you'd like to know when in each episode different things are discussed, so that if things are more relevant or interesting to you, you can skip ahead to those points. To that end, I have put timestamps in the show notes, so you should be able to see when we discuss different things. On that topic, we're going to start this week's episode in part one with the UK news. We're going to look at Fevertree and discuss whether its recent strategic partnership can put the fizz back in its investment case. We're also going to look at WH Smith that announced this week that it was going to be selling or exploring the sale of its high street stores, and whether we think there's a potential opportunity for the business to re-rate as a lower debt travel business. We're going to look at PayPoint and a trading update from what Graham is calling one of the UK's best fintech stocks. We're going to discuss what value are shareholders really getting from its buyback scheme. And finally, in the UK, we're going to look at AJ Bell. Announced a relatively positive trading update this week, but slightly disappointed the market. So we're going to discuss why that might be. We're also going to touch on why Graham is so downbeat on SAGA's prospects despite its refinancing of its corporate debt this week. Then in part two, we're going to shift over to the US and we're going to discuss whether the Magnificent Seven can continue to justify those sky-high valuations after quarterly earnings announcements from this week and the AI giants tussle with DeepSeek. And potentially where you might be able to find better opportunities that are exposed to those same themes. And finally, Megan and Graham each offer one thing they think investors should be paying attention to this week that you might have missed. I hope you enjoy this episode. Let's get into part one. So Graham, it's been a busy week on the Daily Stock Market Report for UK News this week. What stood out to you?
Well, yes, Lawrence, there's been plenty to discuss, and I think the most interesting bit of news we've had came towards the end of the week with Fevertree, which has announced an investment and a strategic agreement with Molson Coors, which is a drinks giant in the United States. Obviously, makes Coors, and it trades under the ticker TAP or TAP, which is quite nice. And so this sort of Canadian American company is putting £71 million into Fevertree, buying shares. Fevertree is returning that money to shareholders in the form of a buyback, although I know, judging by the comments, that not everybody appreciates a buyback, but that's what the company is doing. They're taking 71 million in and they're sending it back out in the form of the buyback. But what's really exciting about it is that Fevertree has a growth opportunity in the United States. That's the fastest growing country in terms of it's getting the most more growth there than anywhere else. And now it will be able to rely on Coors for a lot of help in terms of distribution. They mentioned supply chain, procurement, all these practical things. So it basically means that Fevertree will be able to, have a stronger attempt in the United States. And they're talking about getting a more predictable sort of cash generation from the United States. They're talking about maybe doing another buyback, in due course, because they're expecting the United States to generate a lot more cash for them. So I'm pretty positive on Fevertree. I acknowledge that it is more on the expensive end of the spectrum. If you look at earnings multiples, it's definitely up there. A lot of drinks companies have been derated in recent years. But with Fevertree, what I really like about it is that it's got this niche in mixers where people will often have a lot of different drinks but use the same mixer for each one of them. So in that sense, you can get an enormous market share in mixers, which I don't think you can get with other drinks categories. So yeah, Fevertree market cap, has gone up today. It was about 800 million before the announcement came out. It's up strongly now, up over 20%. So it's definitely expensive if you just look at earnings multiples. Dividend yield isn't huge, but if you put in the buyback opportunity in terms of shareholder rewards, and you think about where it could be in a few years in the United States, I wouldn't be surprised if Coors ended up buying the whole thing at some point. So yeah, I have a pretty positive stance on the stock right now.
I was going to ask you that about an all-out acquisition, because obviously Fevertree was a real stellar stock when it first came to the market, and great brand, great product. It still has both those things, but it's been a terrible investment for the last how long? 3 years. 4 years. It's been awful. And from the statistics that I'm looking at, obviously it's still expensive, even though the share price just hasn't really gone anywhere for ages. And is this best option as an investment of takeover?
Yeah, I certainly think a takeover would make sense in due course, and it wouldn't have to be Coors, but now that Coors is involved, that could be an option. Coors itself, it's not the biggest drinks company in the world. I think it's about $10 billion or so. But in terms of Fevertree and how it got here, the Fevertree share price today is actually lower than it was in mid 2016, according to the Stockopedia chart. So there's been a really, really long period, nearly 10 years, I guess, where the share price has gone up a lot, come down a lot, gone up a lot, come down a lot. But I always said, I'm sure everyone here probably had their own views on Fevertree during that time. I always did feel that the valuation was a little bit pricey, but now at say 20 times earnings or so, I guess I think the US opportunity could be a really interesting leg of growth for the next 5 years. And where will it end? I would say probably it will end in a takeover at some point. So I'm not outright bullish. If you look at what I wrote in today's stock market report, I didn't go all out bullish on this, but I did take a moderately positive view because I do think this could be the next leg of growth.
Does it have revenue from the US at the moment?
Yes, it does, and it's been active in the US for years. It's been taking market share, but I think it's still got a space to grow into there, which it doesn't in the UK. So in the UK, revenue is actually on the decline because the market is saturated. But in the United States, it's still growing double digits.
Is this potentially a way of getting around future tariffs, like striking up a deal with a US-based company to import?
I suppose that's another angle on it, which I hadn't considered, Lawrence. Perhaps.
Are there any barriers that companies run into, like UK companies, if they're trying to penetrate the US market? Have we got any sort of historical precedent there?
I would suggest that probably the most difficult thing is understanding the local sort of situation on the ground in terms of distribution. But now that Fevertree is working with Coors, they've got somebody to help them with that every step of the way. So I think it's a perfect solution to that problem.
Megan, what I sense you're a little skeptical about the investment case here. What would you need to see in order to be more positive on this?
I mean, I haven't looked at Fevertree for a very long time. It was a great growth stock when it first came to the market. It hasn't been, as Graham said, the UK market got saturated, and the opportunities for growth dried up. But the valuation was still and remains very, very high. And I think we've talked a lot before in the past about the profile of stocks changing. And I think this Fevertree is certainly an example of a company which was a high growth compounding quality company, and it's not anymore. The growth figures just aren't particularly. It's still a very high quality company, but yeah, the growth just isn't there. So honestly, I struggle to get excited about it as an investment anymore. And I look at the major shareholders registry, and I feel like I'm not the only one. It's a sea of red of major shareholders selling, including, I mean, big managers like Lindsell Train and Fundsmith, and and actually even one of the founders, Charles Rolls, has been selling recently. So it's a great company. It's a great brand. It's a great product, but it's unfortunately not a very good investment anymore.
Well, here's hoping that this week's news provides a tonic for weary shareholders. I promise that's the end of my puns today. Graham, should we move on to WH Smith? That had some pretty big news this week.
Yeah, absolutely. So WH Smith also in the news this week. So it is considering the sale of its high street business. And I wrote on Stockopedia on the report this week that I thought it was positive news. I think the market broadly agrees with me. The share price has moved up, materially this week, and essentially, the way I see it is that the travel business is the growth side. It's the biggest contributor, and I just think there's when you get these stores in airports, especially, you are in a place where you can charge Disneyland prices, I guess. And when you have a shop on the high street, by contrast, you're competing with anybody and everybody who sets up on the high street. So, you're not charging Disneyland prices there.
And anybody and everybody who sets up online as well, which
right.
is different in the airport. Amazon doesn't do shipping that quickly just yet. So if you're buying the last minute purchase in the airport, it's a slightly different, as you say, charge what they like rather than eroded by competition.
Yeah, absolutely. And so now it's not clear if they're going to be able to sell it and who will buy it and at what price. But they've acknowledged that they're thinking about it. WH Smith also announced a trading statement this week, which had a positive start to the year, but it again showed that the high street division was not doing as well as the travel division, basically. So there was 8% growth in revenues in the travel division and a 6% reduction in revenues in the high street division. So a clear divergence there, and I don't think they need to explain in great detail why they're thinking about selling the high street. Of course,
a trend that's existed for some time, hasn't it? That divergence. Even the amount of investment, I'd say, in like you go into a WH Smith on the high street and it's pretty grim. Like horrid carpets. Like they're not investing money into their stores on the high street, and there's not been an awful lot of interest in the fact that division has been shrinking for a little while.
I was in one of the weekend because I was shopping for a birthday card for my mum, and it's very different to the WH Smiths that I grew up with, certainly. In terms of its valuation, you're saying for a while that this shift has been happening for a while, i.e., it's been reporting less and less growth in its high street business, more and more growth in its travel retail business. I think in this week's report, you basically said it's finally becoming a travel business. Is it valued as such yet? Is it valued as a growing travel business yet, or is it still valued as a faltering high street retailer?
No, it is a good question, and I think what's holding back the valuation may be that the balance sheet is a little bit weak in terms of the debt outstanding. When I checked the most recent results, I found debt excluding leases was £370 million. So bearing in mind, the company generated after-tax net income of £67 million last year. So now that is expected to rise, very significantly, over the next 2 years. But the point sort of stands that I think debt may be holding back the balance sheet. Debt may be holding back the valuation a little bit. But if they manage to sell the high street division for a half decent price, that will presumably be used to deleverage, at least to some extent, which may enable the valuation to pick up again. And I do think it deserves to trade at a reasonable earnings multiple. I think, as with Fevertree, I haven't been all out bullish on this, but I have been moderately positive on it because I think this is a fine company in terms of its cash generation, the track record, and I think now the competitive position in the airports is so strong that I think it has, hopefully many more years of success ahead of it.
Yeah, I think WH Smith, I think that point about the debt's a really good one because it's not great. I guess a negative side of the growth in the airport business has been that it's been very much debt fueled, and it's not great when a company is having to rely on borrowing money to grow at all. So being able to, hopefully, if there is a decent sale of the high street business, hopefully be able to pay down some of that debt might put it into a bit of a stronger position financially, so it can start reinvesting its profits for growth rather than just relying on borrowing, which then puts it back among the high quality companies rather than a highly leveraged company. And I guess that's where I'm more positive about it than I am about Fevertree, because there seems to be a bit more of a plan, a plan that it's under its own control than a plan that relies on external partners, external markets to which it is not particularly familiar with, and currently doesn't have a track record in. So yeah, I think the WH Smith story is quite an interesting one. It'll be interesting to see how that plays out. Interesting to see what kind of valuation they can get for their high street as well.
Should we move on to one of the companies on your watch list? And you said one of your favorite companies in terms of its quality and ability to spit out cash. PayPoint, we had a trading update on Wednesday, didn't we?
Yeah, so PayPoint is one of the UK's best fintech stocks. Of course, that's obviously said slightly in jest because it's an old-fashioned business in terms of it has an old-fashioned energy payment activity that it does, an energy payment service that it does, bill pay service. But it is it has actually a multifaceted set of services that it provides to convenience stores, to just ordinary customers, and it's got some of the best quality metrics and cash generation statistics you'll find in the mid caps. It's about 500 million market cap. And so this week it came out with a trading update where it was on track to deliver expectations. If you look at the top line net revenue, okay, I acknowledge that it's not growing terribly fast. Net revenue was only up 1.9%. But I think if you look sort of at the different segments, there are parts of it that I think are very interesting. So, for example, in e-commerce, they have this Collect Plus business for parcels, where volumes rose 37%. Now, revenue there is still very low, but it is growing very fast from that low base. The Love to Shop shopping voucher business had another solid performance. And, aside from that, they've got the shopping division, which is the terminals in convenience stores. And they've got a payment and banking division as well. So on the whole, I acknowledge that the growth isn't super exciting, but it's just such a reliable performer, and the quality of the performance is so decent that, I don't know, I've always felt like this was a quality company, and it always trades quite cheaply. PE multiple about 9 times, paying a yield of over 5%. Yeah, I think for a solid mid cap, it's just one of my favorite sort of buy and hold kind of candidates. I've held it before in portfolios I've managed. It's always done reasonably well, and they buy back their shares as well. So I think that earnings per share can improve, with the help of those buybacks, as well as hopefully some decent underlying growth. Not the it's not going to be the next Nvidia, but it's just a really solid mid cap.
We will, of course, come on to Nvidia in the later part of this conversation. You said they've got a target of £100 million of EBITDA by the end of financial year 2026. What could stop them achieving that? Like, what's going to get in their way?
Honestly, I think it's in their own hands, because they are buying back their own shares. They are paying high dividends. It's really up to them.
So, been a bit of chatter this week in the forums about that share buyback policy, and I'm going to play devil's advocate because I actually I personally don't mind a buyback policy, especially when companies shares are looking decent value, and they're generating a lot of cash. But some of the questions that people have been asking is it really the best use of cash, especially if they're operating in a growing market? And I guess that is slightly true of PayPoint. Like, why does management, and what value really are shareholders getting if they're using the surplus cash just to keep buying back shares?
Okay, so they've got a £20 million buyback program currently. There is a chance that they could pay out significantly more than that next year and the year after, depending on how things are going. So if, for example, over 3 years they spent 20 plus, say 25 plus 30. So if they spent £75 million buying back their shares, that would reduce the share count by something like 15% at the current share price. So you would get an increase in earnings per share of more than 10% purely from that action, which would mean that the dividend per share could be increased as well as a consequence. So really, if they don't think that they have the growth opportunities to earn a lot more than that kind of return, and if their existing opportunities are already fully funded, which I believe they are, then I don't see the harm, because the alternative is to pay down their debt, which they don't really need to do, in my view. So obviously there's a balance to be had, and this is every company has to make these decisions. There's never a perfect right answer, and it's never only one thing. And you always have to allocate funds out to a broad range of opportunities. But to me, this is quite proportional.
You made a point, I think, in the comments, which one of our subscribers congratulated you as a huge point well made, about I think he was referring specifically to the point about the fact that PE ratios are based on shares outstanding, not shares in issue. Could you explain that a little bit more?
But yeah, so when a company buys back its shares, there's a question about where do the shares go? Do they disappear? Do they go to wherever shares go in the afterlife? Actually, the company has an option about whether they keep them in, it's called keeping them in treasury, or if they actually just delete them, which is called cancelling them. I don't care whether the shares are kept in treasury or whether they are cancelled, because even if the company cancels them, well, some people will say that's good news because it means that they can't be sold again, they can't be reissued. So that means I'm not going to be diluted in the future. I don't really see it that way. If a company cancels its shares, there's nothing stopping it from making new shares in the future. So I don't take sort of confidence if a company cancels its shares. I don't care whether they're cancelled or kept in treasury. It's all the same to me.
With them being kept in treasury, is that effectively saying that the company has an ownership of itself, of the shares that still exist? So let's say it's a £100 million company and you own 1% of it. If the shares are kept in treasury, would you still be owning 1% of it? And if they were cancelled, you'd own more. You'd own a higher percentage.
No, because those percentages about ownership are based on shares outstanding. So shares outstanding is the key number that's used to decide things like earnings per share or dividend per share. If a company has shares in treasury, from an economic point of view, they don't exist because they're not used for anything. They're just a record on a piece of paper. But in terms of all the metrics that we calculate, that's all based on shares outstanding, which means shares that the company doesn't own, shares that are out there in the world with third parties.
Shall we move on to AJ Bell? On the face of things, a relatively positive trading update this week. Assets under administration up 3%, customer numbers up 4% in the quarter, but the market was a little disappointed by this.
Yeah, so AJ Bell shares fell 2% on this, which it's not a very meaningful fall. But I suppose the main thing I want to point out with AJ Bell is just that when people look at a stock like this or at Hargreaves Lansdown, people are expecting a lot more from these companies than they do from the actual fund managers. So, when people are saving into their ISAs and their SIPs and their other accounts, it's actually the platform is considered a far more attractive investment with far higher prospects than a lot of the fund managers that people might be using on these platforms. So AJ Bell, for example, it tends to have a pretty strong valuation. It's currently at about 20 times earnings. But I'm positive on this one because I think it has, I'm not a customer myself, but from all the, the reviews I've read, people seem to prefer it over a lot of the competition. You look at its trends, and it is making very consistent growth over the years. I think it's got to be taking market share. And so, for example, customer numbers up 16% year on year, according to the trading update that came out this week, with the direct to consumer customers, so people signing up as individuals, that sort of set of customers up 20% year on year. We've got decent inflows. I mean, it was a good trading update. The shares were down. People were wondering, why is it down? Maybe there's a slight reduction in the growth rate. I did some comparisons and I saw, well, net flows maybe are a little lower now as a percentage of starting assets compared to last year. So maybe things are slowing down a little bit, but I actually think this is worth the price that the market is charging at the moment on balance. Of course, nothing's guaranteed, but I do think this is worth an above average multiple.
So AJB, I think, is it's interesting. I think it's interesting from a consumer perspective. I downloaded the app, had a little play around with it. It is a very good app. I was wondering, Graham, do you know how many of the customers, how many of the assets under management, how much of the revenue is generated from the two divisions of the business, the direct consumer portion and the advised part?
Well, according to last year's results, they had 371,000 direct-to-consumer customers versus 171,000 customers on their advised platform. And in terms of assets under administration, that was actually much bigger on the advised platform, with 56 billion pounds under administration versus only 30 billion assets at the direct-to-consumer platform. So direct-to-consumer has higher customer numbers but smaller assets under administration. In terms of revenue, I'm not sure exactly how that splits out, but that just gives you a sense of their respective size.
Yeah, it's interesting because obviously, I mean, I assume that the advised section of the business is there are higher margins in that part of the business. I assume that once they have their clients who are using the advised part, that they're stickier as well. I mean, it's not that difficult as an individual investor to switch platform. But I wonder what the growth prospects are like for those two divisions of the business, and how which of the two elements is going to provide sort of the future growth potential at AJ Bell.
Yeah, and there is a risk, I suppose, that they run out of growth before too long. But it seems to me that at the moment they're just taking market share. And maybe that market share is coming from Hargreaves Lansdown.
Yeah, I mean, I see it. I see less and less of Hargreaves Lansdown, like just among chatter about what kind of platforms people are using. I mean, I've never used Hargreaves Lansdown because I've always been aware of the fees. But I wonder maybe if the fee situation is now becoming more high profile, and the competitors like AJ Bell have caught up in terms of usability and number of funds and stuff available.
And I'm sure Hargreaves Lansdown, their new owners will have some thoughts on what to do as well. So it will be interesting.
Yeah, I know. I signed up with Hargreaves Lansdown before I was aware of just how expensive that it could be. To wrap this part up, Graham, obviously you've been paying a lot of attention to the UK news flow this week. What's one thing that you think investors should be paying attention to this week from the UK that they might have missed?
If I had to pick one thing, I'd probably note that we had a takeover. We had Good Energy with a cash offer at a 24% premium that was covered by Roland. So I would say the takeover story is not finished yet. We will hopefully get attractive takeover offers until the market re-rates. Obviously, it's not nice to see the number of stocks continue to fall, but if share prices remain, at these levels, for offering pretty decent value in small caps and mid caps, then it is an antidote.
Did we ever get to the bottom of why SAGA was up so much this week? I know I had a trading update today, Thursday, but the share price was up quite a lot during the week as well.
I saw some comments on the discussion forum that it had managed to refinance its corporate debt, which was quite large.
Yeah, I think the refinancing may have leaked out a little bit early, perhaps.
But Graham, you're still red. Why are you so negative about SAGA still, even though it's refinanced its debt?
Well, look, I'm a little bit biased against SAGA, and I think it's the concept that just annoys me. The idea that once you turn 50, you need to, go somewhere else to buy your holidays and your insurance. But speaking seriously, it just strikes me as an accident waiting to happen. I acknowledge the refinancing is great news. The trading update was not terrible. We look at the historic numbers here. Okay, COVID was a big problem, of course, but even since COVID, even when other travel companies have been doing quite well, this one hasn't. I don't really get it. I don't understand why they have to leverage themselves up so much. I do think the disposal they announced, they are trying to deleverage. It makes sense. Hopefully they succeed, but I just don't see the attraction. For most companies, I'm looking for a competitive advantage, something interesting, something new. With this one, it's just, are they going to survive? Maybe, hopefully, and I don't see the attraction.
Yeah, that's not particularly inspiring, is it? Are they going to survive being the the way to look at the investment case?
Hello, Editor Lawrence here. Just before we head into part 2, I know a number of you listening are already subscribers to Stockopedia's stock market research platform. If you are, thank you very much. If you are not, and you enjoy the analysis of UK shares like you just heard in part 1, I think you'll really enjoy our daily stock market report on Stockopedia, published every weekday by Graham and a number of the other writers from around Stockopedia who've also appeared on episodes of this podcast. You can access it for free for 14 days using the link in the show notes. You'll also unlock the rest of Stockopedia's insights, tools, and education to help you speed up your research process and make more informed decisions. Let's get back to the conversation. In this part, we're going to chat about Chinese DeepSeek. We're knocking $600 billion off NVIDIA's market cap. We've also had quarterly updates from a lot of the rest of the Magnificent Seven. Megan, you've been taking a look at these, haven't you?
Yeah, so starting, I guess, with that DeepSeek point. Graham, I know you also had a look at NVIDIA in the fall. I mean, the movements in this stock when it moves, it's just mind-blowing. It was the entire market capitalization of MasterCard, which is a big company. I mean, a move that was larger than all companies in the UK. So, yeah, I think quite an extraordinary thing. I think there's been obviously a bit of back and forth about whether or not this was inevitable because NVIDIA got overheated. And Graham, I feel like that is potentially the side of the fence that you come down on. But the AI market is still growing at a phenomenal pace. And because there is another player in that market, it doesn't necessarily take away from the incredible demand that is going to be heading the way of NVIDIA. And I think one of the reasons that this is true is because DeepSeek is claiming it can the kind of things that NVIDIA makes. So the requirement, they're suggesting that potentially the requirement from companies like, any company that's exploring artificial intelligence, they might have less demand for the kind of chips that NVIDIA makes, which would be true if the growth in the market had slowed down. But I think a view that is shared among quite a lot of people who remain positive about NVIDIA is the fact that if companies are finding that there's more capacity for their chips, they will simply do more in the AI space.
I heard that there was a massive spike in Google searches for something that I hadn't heard of called Jevons paradox this week, which is basically what you're describing, Megan, is that increases in efficiency will lead to increased consumption rather than decreased consumption. So that's, I thought that was interesting.
My concern is more about the hangers-on, the companies that put AI in their name and they say that they're machine learning experts and they're AI experts. There's this little sort of cottage industry of small caps calling themselves AI companies. NVIDIA itself, I don't have a big problem with it. I do think that it's part of that Mag 7, which broadly speaking looks rather overheated to me. And I do think that there are risks when people assume that that AI is going to be the place where they're going to get rich. It might be, but every few years something else comes along that is the next big thing. I suppose I'm too old now, even though I'm not really old, but maybe I'm so old now when I see all these companies worth $2 or $3 trillion, I start to get nervous, but maybe it all makes sense.
I don't think it's an age thing that is makes it fair to be wary about so many companies worth so much money. And I think I was listening to Stephen Yu, who's a fund manager at Blue Whale, but he was talking about how the way that they run their fund is very much if they believe in one of these big companies, they take a bigger bet on it than its position in the market. And if they don't believe in these companies, then they look for a different one. And that's the way that that's their approach that they take to beating the passive indices. And it's actually an interesting way of looking at it as a private investor as well. Taking a big position on a company that you have a huge, high conviction about is quite interesting. But if there are ones that you're slightly on the fence about and not really sure, then look for something better. And I think that's something that's amazing about the US is the depth in that market, the quality of the stocks, not like beyond the Magnificent Seven, and the growth and the opportunities that are available for investing in the US. Is really exciting. And you look at the results from the three companies, the three Magnificent Seven companies that announced their results on Wednesday evening. And none of them were particularly inspiring. And Microsoft is another $3 trillion company, incredible company. But with a valuation like it does, you're wanting it to beat on every level. And the area that the company actually disappointed on was the cloud AI division, which obviously triggered a bit of a wobble in the share price. I mean, when you're on a valuation like that, any little disappointment's going to trigger a wobble. For Meta, incredible results, earnings expectation like massively beaten, and beaten on the revenue level as well. But the company was only willing to give guidance for Q1 on the revenue level, which sent a little bit of question mark. Why are they not willing to guide further out in 2025? And then the question maybe for private investors is, where else could we be looking in the US? And I think there are a lot of other opportunities.
Yeah, and highlighting the opportunity in the United States, I just point out that the company that we were talking about in the last segment, Fevertree, actually generates more revenue in the United States than it does in the UK. So just to highlight that opportunity in that enormous economy they have.
It's just such a different scale. It is interesting with Fevertree. I think I didn't actually know that they generated more revenue in the US than they did in the UK. But yeah, I suppose it makes sense. If you're in the US, you probably should be generating more revenue there than you are in the UK. It's so much bigger as a market. Often called the graveyard for UK companies, though, the US.
I want to talk, if we may, about the level of investment in AI, especially by some of these Magnificent Seven companies. Microsoft and Meta announcing massive and defending as well their massive investments in AI. Have they given any guidance or indication what the timeline is for seeing a return on those and how that's going to impact their revenue and bottom line?
Well, I think Meta sort of hinted at it by saying the revenue guidance for the rest of 2025 is good, although they didn't actually give a number, because we've been investing quite a lot. But yeah, the scale of the investment in AI is ticking up enormously for both Meta and Microsoft in 2025. So Meta's announced capital expenditure of between 60 and $65 billion. And Microsoft as well, capital expenditure. They're planning on spending 80 billion in this fiscal year to build the data center infrastructure for training AI. The chief executive of Microsoft, who comes across as quite a mild-mannered man, he got into a bit of a spat on Twitter with Elon Musk about the level of investment. He said, all I know is I'm good for my 80 billion. And all this money is not about hyping AI, it's about building useful things for the real world. So quite defensive almost about the amount of money that the company is planning on spending on building AI models. But yeah, I suppose investors will want to see a relatively quick return on that capital investment. It's capital expenditure. They're not putting it through the income statement. It would be unusual for a company of that size to be expensing their investment, but it's something that if the benefits of this expenditure are going to be coming within this year, maybe it should be being expensed rather than capitalized and put through the balance sheet. From a purely accounting perspective, it's probably investment that's going to pay dividends in the coming years rather than immediately.
Does that level of investment, it's sort of 65, 80 billion for Microsoft and Meta, is that like a material step up in terms of their annual capital expenditure, or are they just diverting funds that would normally be invested elsewhere?
It's massively higher. It's double what Meta spent this year, and I think it might even be more than double for Microsoft. I mean, they've got a huge amount of cash, so it's not something that is at all troubling. These businesses are enormously cash generative, sit on vast quantities of cash, and have loads and loads of short-term investments. I mean, Microsoft obviously has a $14 billion stake in OpenAI and is going to, if OpenAI start making money, will start generating profits from that investment as well. So they've got the money, they can afford this level of expenditure. It's good, I think, to see that they're willing to commit. And this is another thing that Stephen Yu was talking about in this podcast. The fund's been selling down Microsoft because his argument is that the free cash flow yield for both Nvidia and Microsoft is roughly the same. But if you look at how they've been spending their money, the volume of expenditure at Nvidia is significantly higher. And if you're valuing a business, you're obviously valuing it based on the potential future earnings and cash flow. And his argument is that Nvidia's done more to invest for the future than Microsoft and others have done, which is why he's hanging on to that one. Their fund extraordinarily they've got a 10% cap on how much of the fund can be exposed to just one company. And Nvidia is always 10% of their fund. They've sold more shares than they currently own because they just keep on having to sell because they're right up against their limit. It's just an extraordinary growth story.
It is incredible. On Nvidia specifically, I was having a look at its stock report. It's currently got a quality rank of 94. I think margins are huge. It's got operating margin nearly 63%, returns on capital of 90%, return on equity of over 130%. How sustainable is all of this if new entrants can come into the market really quickly using, as we apparently saw with DeepSeek, Nvidia's cheaper chips?
Yeah, I think it's an interesting point, and I think that's something that is the main worry for investors who think that the stock might have become overheated. Is the company going to have to sell its chips for cheaper, and how might that impact operating margins. I mean, that is a thing. If companies with a very strong defensible position, if that attracts competition, it can lead to margin erosion. I mean, it's what happened at Fevertree. Yeah, my view is still that there's still a little bit more time to come. People who are nervous, by the way, there are some really interesting opportunities in Europe which are exposed to the same sort of themes. Like, we had results this week from ASML, which is a Dutch company, and SAP, which is a German company. Both big AI infrastructure plays rather than AI application. So the application side is more like what Microsoft and Apple and Meta are doing, but the actual infrastructure, which is where NVIDIA sits, there are some interesting opportunities in Europe there. So they're good ones to look at for investors who might be a little bit more nervous about the situation, the overheating in the US.
I want to come on to a question we had from a subscriber about end users of the chips. Question from Mark Carter, who says, I don't really know what these large companies are doing with AI anyway. I suspect it's mostly a bandwagon. Obviously, NVIDIA is a clear beneficiary. Apple says, built into your iPhone, iPad, and Mac to help you write, express, and get things done effortlessly. I expect it's the same for Microsoft, he says. If that's the case, isn't the recent news this week a good thing? If Apple can now provide its tech more cheaply, for example, is this a benefit for Apple?
So the end user, the customer, so those that are building AI applications, so that is like this reader saying, sort of what your iPhone can do. And I mean, Apple's got a really, really good advert. I'm pretty sure it's Apple. The one where someone writes a really angry email to their coworker, and then they get AI to make it more polite. I think that's so funny. But yeah, so for that end application, having more efficient chips is a positive thing, and it does mean that they'll be able to run more applications on a smaller number of chips. So yes, companies like NVIDIA, which provide the infrastructure, are the ones that are going to be more eroded by that. But with these massive companies, like Apple, Meta, Alphabet, even Amazon, there has been a drive, and this is where all this capital expenditure comes in. There's been a drive for them to start doing their own infrastructure, so reducing the need to spend on NVIDIA chips and the like. So that's where there is a positive and a negative for these larger companies in the arrival of a cheaper Chinese counterpart. I mean, there are still questions, to be honest, around the cheapness and the legality of this Chinese counterpart. OpenAI has actually said now that they're pretty confident that there's been some intellectual property theft that's happened by DeepSeek in training their AI models. See, that could end up in some legal wrangling. It's also like there's always questions, I think, over announcements that come out of Chinese companies. I think there is a general distrust there. So I wouldn't say that anything that's happened this week would create a cause for concern above what we knew before this week. I don't think the story is any different. I think the fundamentals of these companies remain. So, and until they don't, I'll remain positive.
I'm going to ask you the same question that I asked Graham in part one about the US markets. Obviously, you've been paying a lot of attention to them this week. What's one thing that you think investors should be paying attention to this week but might have missed?
So obviously, all the hype is often around the Magnificent Seven. There have been other companies this week in the US that have had financial results. One of them was MasterCard, and MasterCard remains a fantastically high quality company. I mean, it pretty much shares a duopoly that doesn't seem to flies under the radar of the regulators. With Visa, also a very, very high quality company. And so each of the last 4 quarters, it's just consistently doing better than what analysts are expecting, and which ties in very nicely with the research that Ed has been doing this week. That wasn't. I didn't tee myself up for that. It just is the kind of thing that you should be looking for with these high quality companies, those that can continue to exceed expectations. So MasterCard is a great business. So while everyone's being distracted by what's happening in the world of AI, there's other great companies that are exist in the US.
Ed's research was on post-earnings announcement drift. We had him on last week's episode of Companies and Markets Weekly to talk about some of the preliminary findings from that. I will link to that episode and a PDF of the research in the show notes of this episode. Finally, to wrap today up with the both of you, I want to ask, obviously NVIDIA lost $600 billion off its market cap in one day this week. What would you buy with $600 billion?
I mean, I quite like the look of my MasterCard. $524 billion there, so I'd have some change.
Yeah, I would also pay off my credit card.
I contentiously would maybe have a look at Greenland, because I hear that's something that people are wanting to buy at the moment. See if I could flip that. And that brings us to the end of today's episode. Thank you so much for listening. And thank you as well so much for people who have taken the time to fill out our most recent feedback survey. We're always looking to understand how we can make this show more relevant and valuable to you and your investing. So if you've not done so yet, you can find a link to that in the show notes too. If you know somebody who you think might enjoy or benefit from this conversation, we'd love it as well if you could share the episode or the podcast with them and spread the word. And of course, we always really appreciate it when people leave us ratings and reviews on Apple Podcasts or Spotify. If you are listening there, it really does help other people discover and benefit from the work we're doing here. So that's it. Thank you very much for listening. We'll see you same time next week for the next episode. Bye for now.